Hello, everyone, and welcome after our summer break for another of our webinars, BizTalks, or whatever you want to call it. And we are here with two very special guests, and today we will talk about a very special topic for every single entrepreneur on earth about the predictions, or maybe just your startup is a bad idea. But before we start, I would like to tell you why we are here in the first place. It's because Plugin Foundation is partnering with Fundacja Dobra Porażka on the Good Failure Day. And this is a very unique conference organized all in Polish language. So unlike our talk today, it will be in Polish, and it focuses on taking a little bit stigma from the failure and helping people learning from it and developing in a friendly environment where you can share your failures and learn from them and grow together and progress. So the team is how to prevent failures, and it will be on the 13th of October, so exactly in 1 week. And because you are here, we have a special contest for you. And you can get the free ticket for this conference. All you have to do is write about your biggest or the most hilarious failure, and our guest today will help us choose the winner. So without further ado, I would like to introduce you to Mr. Mick Griffin, Chief Growth Officer of Traffit, and Mrs. Dagmara Lacka, founder and the CEO of Flow City. But I will not speak too much, and I will give them the voice so they can tell a little bit about themselves. So please, Dagmara, can you tell us a little bit about yourself?
Hi, Dagmara here. I've spent most of my working life in advertising, a little bit of press, then moved on to online, and I ended up founding a business that disrupted billboards. So the idea is that you can buy a billboard in the same way as you buy an online banner, with a view to help businesses grow. So growth of my business and other businesses is something I'm very passionate about, and it's actually part of my company's mission.
And now, Mick, can you tell us a little bit about yourself?
Yes, hopefully, yeah. So Mick Griffin here. A very nice introduction. Thank you. So I'm Chief Growth Officer at Traffit, which is a recruitment platform tool. But basically, in a nutshell, I've been very lucky to work in SaaS startups for around 13 years now, all founded out of Poland, which was a really nice experience for me. I got very lucky to fall into that space, living here in Poland, originally from the UK. And yeah, I'm really happy to be here today because my experience is I've been winging it for such amount of time and learning from mistakes in my career, because I kind of fell into tech and sales and marketing by accident, and that was 13 years ago. So I got quite lucky, but have been learning a lot of things on the fly. So hopefully sharing some of those good mistakes and those good failures that people can take a little bit of advice from it. But really thankful for being here.
So we have a quite unusual situation. We have a Polish person living in the UK and an Englishman living in Poland. So a little bit of that mix of experience and a lot of, I believe, a lot of different like questions and experience of living in those different countries. So let's jump to the main topic. And all I wanted to ask, because we're talking about bad predictions or bad startup, and those predictions are changing obviously a lot over the growth stage of startup. So at the very beginning, you focus on different things, than when you grow on a different things as well. And when you hopefully reach that maturity level or IPO, you also try to predict or focus on a different things. If you can tell me, like at those different stages, what in your opinion is the most important, or what entrepreneurs should focus on, and yeah, Mick, if you can start with that.
Yeah, certainly. I think, the first thing I would say is I think that kind of assumption that projections change at those stages doesn't always happen, at least in my experience. Sometimes you are shocked that you are still following the same projections you made 2 years earlier, and you never really realized it was a time to stop, which is, that was the one thing I wanted to start with. But yeah, I think I think from a creating of a projections point, it's definitely a lot about the motivation for why you are making that projection. So in the early days, maybe pre-fund, pre-seed, you are making that projection because you need to predict how much money you need to survive. But of course, when you're getting towards like an A round, B round, or IPO, I feel like definitely the motivation changes, because you are using your projections to try to drive the highest valuation or the highest value of your business, which are two such contradicting motivations in such a short period of time, right? So I think a lot of it is down to the motivation of why you are actually creating the projection in the first place. And I think that's one of the biggest changes that I've noticed over those two kind of distinct periods. One is you're doing it for yourself to survive, and then the second one is, okay, which one is going to drive a valuation or so on. And that's a topic I think we'll probably dig into a little bit later. But I don't know, Dagmara, from your side.
Yes, I agree with that. So the motivation is the key here, and that actually leads to the motivation of your investors. So who you're gonna pitch to will determine the type of projections you should bring to the table, because if you're pitching to a group of angels for 250K will be different than pitching to super angel who will only consider ideas that move the needle for him. So he will only consider businesses that are ambitious enough and have a chance to really go all the way. So understanding who you're pitching to is really important. And I've been in situations where I've overshoot, but also under projected. And it's really too late at the meeting to say, actually, we've got another scenario we could discuss. It shows you haven't done your research, you're not understanding the motivations of your investor. So that's at an angel stage, where most of the startups, well, every startup I think goes through an angel state. You may go straight into seed, but institutional seed, but most of us will actually raise money first from friends and family, and then from angels. Then once you go into institutional investment like venture capital, then your projections really have to have legs. So it's either based on the data you've gathered, so saying that with 10,000 investment, we've managed to acquire that many customers. So with 100,000, we can predict that's how many customers we will be able to acquire, because our market is ABC, and then also having a good source backing up that total addressable market. So those are two key elements where your modeling, those two legs your model has to stand on.
Okay, and a little bit from the other side. So what are the mistakes that you see in the projections, or maybe even the mistakes that you did yourself in creating those projections or working with them? Maybe Dagmara now.
So the common mistake, I actually hired a person that does those projections professionally, because when I did it myself, I didn't do it correctly. So the typical mistake you do when starting out, you will put your marketing spend in the same category as your overhead. So it will be a flat figure, where in fact it should be a model, as the name says. So the money that you get from revenues is reinvested, which means you're not burning through marketing spend if it's not working. So that's, and a seasoned investor, not even a VC, a knowledgeable angel will look into your model and check the formula. So making sure that your formulas are solid and understanding how those formulas work is key. And that's the mistake I made, and got a professional to do it for me the second time round.
Yeah, that's very important. It's like sometimes if you know that like it's something didn't work, maybe get someone who knows what he's doing and learn from that person, or work with that person. So that's very, very important. And make from your side those mistakes.
Yeah, and certainly I think one kind of like fundamental thing was just being probably too self-critical, that the numbers were just not good enough when you made the first round. But to be honest, I think the bigger, maybe more obvious mistake that I've made in the past that people might be able to take away is that we predicted that all the metrics, all the KPIs would gradually improve at the same time. You know, and we didn't have this kind of farmer metric that you have to let one settle while the other one improves. And we didn't really take into enough consideration the resources connected as well. So, you know, it's really hard to submit that prediction for a year and show 6 months of a major KPI like conversion or revenue or average revenue per user just being static. And that was a terrible thing that we kind of we just gave in. Okay, let's just show a little bit of growth. Let's just show 0.1% per month, just so it looks like it's moving. And ironically, I definitely won't paint investors as bad people in this thing, because you know that was us predicting that investors would be disappointed, and most of the time they're not. You know, most of the time they're not. So you really just underestimating that. Saying that a number will move 0.1% every month, those things add up and they become really challenging, and you end up underwater a little bit.
Okay, thank you. Thank you very much. I just recall one thing that I should probably said at the very beginning, because we have chat here and we have very, very knowledgeable and experienced people. So if you have any questions for them, please write them in the chat, and we will take a look at them at the very end of our call. So please mix those hilarious or biggest failures with the questions, and it will be definitely worth reading. So as you said that you were expecting the KPIs to grow similarly at the same rate, and like, do you have any specific like KPI that you see that like is either like maybe like reaching the plateau over the time, or even like decreasing, that you now know that like, oh, probably we should expect that?
So I have one that comes to mind, if that's okay, Dagmara, because it's just really fresh. We just recently, you know, six months ago at Traffit, we investigated some fundraising, and we met with some really great VCs. And yeah, one thing that we really predicted, and I did this a little bit out of fear and nightmares from previous ones, but we actually predicted when we increased some marketing campaigns, where we showed like growth in marketing campaigns, we showed decreases in, you know, what we would, you know, website to trial sign up, and still in some respects like lead to sale conversion, because we literally had to show that when we will increase that budget, a lot of it will be experimental. And the VC at the time actually, you know, again, we made a lot of mistakes, but also the VC said like, great to see. You know, like it scares him and her when they don't see that. So one thing that really helped by saying like, this is going to be a particular growth moment for the business at Traffit, and here we have to build some room that we are going to do some of that wrong, and that was really helpful for us.
Dagmara, if you have or you know any KPIs that you want to share, there's no pressure, obviously.
Well, I'm just trying to think of a KPI that is not specific to my business. So we've got average transaction that we've predicted, and actually for many years we kept around that average transaction, even though we had some really big transactions which we probably should ignore and use standard deviation technique, but we just take all of the revenue and multiply it by number of transactions. But I think when we see a lot of big ticket campaigns, we reinvest that margin into marketing and get a lot of low margin campaigns. So I think this is a self-perpetuating model, a growth model that is particular to our business. But what's amazing that the very first campaign that we did on FlowCity back in 2016, it's actually still our average, more or less. So it's incredible how that stayed, and we often comment on that.
Thank you. And like now, let's take a look at slightly different angles, because obviously you can think about predictions and projections from different perspectives. You can look at it from the perspective of the product or services that you're developing, or in terms of what is most interesting for your investors or shareholders, and also in a different time frames you would probably focus on the different things. So in 3 months you want to be focusing on these things, but like in a 12 to 24 months period you're probably look at the different things. So like in a term of those types, so like what is the most important for you when you're developing your businesses or working for a startup like Traffit? Is it mostly like focusing on the products or something else?
Dagmara, maybe you want to, yeah, please go ahead.
I think mine will be very quick. So I pitched to about 100 investors. And number one thing they wanted to see in terms of KPIs is number of customers, how quickly you grow and how quickly you can get to 1,000. 1,000 seems to be this threshold where it's a big enough sample statistically that it allows you to have the proper product market fit. By that time, your product is standardized, and especially in SaaS businesses, that's what they want to see. For me, internally, operationally, it's revenue, because that's what pays the bills. So that's what gives me the fuel for my rocket. So balancing those two, acquiring customers while retaining revenues and margins is my daily struggle. It's fun, but it's the daily struggle. So investors always want to see the number of customers you can bring and how quickly you can get to 1,000.
And Mick, from your perspective?
Yeah, so I will approach this from you, because you mentioned one that was really good, which you mentioned product. And I mean, in my experience, product have always been the last in the queue, sadly. You create your projections based on your revenues, your investors, your new sales, your even your vanity metrics, and then you tell the product team to build something to achieve it. I don't think they really, even to this day, they don't really get too much of a say in the early stage. I don't know about from your side, Dagmara, the same.
Same. And I mean, there is nothing that petrifies investors more that you will end up building something because you really want to implement that bit of technology. Mm-hmm. It's really cool. For AI is a great example, or a machine learning, which is similar. But yes, they actually happy for you to have a lot of the processes manual whilst you servicing customers, and then the product to catch up and actually fill in those processes that you've nailed down. So actually, tech business has little to do with technology and a lot to do with the process, because once you have a good process, you can build a tech that will imitate that. So that's what investors want to see.
And from our side, it's quite ironic because, you know, I think about, you know, I would probably say like retrospective analysis of projections is probably so much more valuable for me than predicting into the future. But ironically, you know, when you are looking at, you know, in the businesses that I've been in Brand 24 and in Traffit still, a lot of those spikes, a lot of those growth metrics do actually come from changes in the product. So, you know, we implement a feature or finally complete an integration and you're like, wow, we had a peak in April of new sales or new trials or new leads or something like that. However, when you're projecting to the future, you are not really considering too much that product. So it is ironic, but, you know, coming back to the original question, I remember a time at Brand 24 when we got ourselves in a little bit of a mess because I think we ended up with like 4 different versions of the same projection. And it was like, okay, right, let's make a pessimistic version, an optimistic version, investor-facing version, and an internal team, you know, facing version. And at the time, you feel really comfortable, like, yes, okay, they see what they want to see, everything. But then after 2 months, it's a mess. It's a disaster because you change one, you didn't change the other, and so on. So that's something that even at Traffit, we almost fell back into that hole a little bit, and we stopped ourselves. We don't know, okay, if we're going to update it, we update it for everybody. Let's keep one. But yeah, we ended up with 3 or 4, even 5 different versions. It was a little bit of a mess, but a really good learning curve.
I gotta admit, I would love to see the differences between the internal version and the one for investors. Probably would be amazing to see what.
The ironic thing is, it wasn't so much the difference in terms of what we predicted to deliver. It was also the fact that we knew that, or we had this impression that, okay, the investor shareholder version has to stay static. Once we submit that, it's staying for a year. We are not going to go, and maybe that was also wrong, by the way, doesn't mean that it's right. But the internal one, we were like, okay, after 3 months when we were off track, we were like, okay, let's update it a little bit so we know where we need to spend the money, how much more money. But it was more that fear of updating the shareholder one and changing it and submitting a new one. And this was long before IPO, by the way, not post IPO. That's a whole different scenario of fun. Yeah, even in the early days, like, you know, after an A round. So it wasn't so much like, let's tell the investors high and we predict low. It was more a case of after 3 months, like, okay, we want to update the projection, so that one has to stay the same. We can't make the investors feel like something is wrong. Let's be calm, but internally, let's look at the different scenarios. So yeah.
Well, it wouldn't be possible in some of the startups, because in UK it's typical that any significant shareholder wants to have a board seat or wants to listen to the board meetings, and those have to take place monthly. And all those things are updated on board meetings, and then then the follow-up is what we call an investor newsletter. So it depends on how rigid your investors are or shareholders. So I think you've got nothing to hide. If they did not request that information, it's also their responsibility to be active and requesting updates.
And you know, the ironic thing is, and I wanted to bring this up, maybe I'll bring it later. This also what we would call like the projections tend to have this one metric that actually is the most important one, whether or not it's revenue, normally most of the time. And what you would do is you would say, okay, well, we have this projection for the year for shareholders, investors, and we need to end up on this number on December, let's say, and you get to March and you are not quite on track. So you adapt your internal one to end up at the same point so that your investors won't feel the difference, but you are mixing all your numbers, changing your conversions, your top of the funnel, your bottom of the funnel to catch up. And then again, this is where we talked about this, that, you know, in the very beginning of this topic was, at some point your projections start to drive the company and not help the company. And that's like why I wanted to talk about it today, even.
Yeah, that's very interesting. You're right, that does happen. And I mean, we do it all the time. We do it weekly.
Catch up.
But I just, I've never thought about having two models. It didn't occur to me, but I guess maybe that's one way to keep peace.
I guess we wouldn't do it again. You know, I guess it's just, again, it was a really good lesson learned. And again, I think it's just that level of learning that the type of communication you can have with your investors, and not every investor obviously is easy to do that, of course. But yeah, definitely it was a really interesting time, because also I still remember that one of our investors even did ask for this pessimistic and optimistic version. They asked us for two, because I think they also thought that maybe we don't know where the middle is, you know. So guys, tell me worst case scenario, best case scenario, and that's probably quite useful, as long as at the end you merge and you don't stay with two. And that was, so I think again, it was all coming from quite a young startup environment of trying to make sure that everyone feels good and comfortable, instead of just sometimes the answer was just to have some tough conversations. And I think, Dagmara, you talked about that, having a really good relationship with your shareholders and investors now, by being okay with having the tough talks and the tough news and sharing the tough environments.
Yes, absolutely. I mean, it's fascinating to listen to you, Mike.
I feel like you partially answered like at least 3 other questions that I had.
Sorry, I'm sorry.
No, that's fantastic. That's absolutely great. But now I will jump a little bit ahead, because what Dagmara was talking earlier, that a lot of investors are happy with having a lot of processes done manually. I heard about one like quite famous startup that came from my university, where the guys just didn't know the technology, but they knew exactly what they want to do. So they did everything in Excel manually, secured the customers. Absolutely. And the moment when they got the money from investors, they just hired the guy who built the product for them to do Absolutely. It manually. Yeah, so a little bit on that. So like jumping ahead, I wrote that we live in a time where a lot of is changing, both in technology and then customer behavior. So I would like to ask you about how that affects your projections. We met last week to talk a little bit about the webinar today, and Dagmara mentioned the QR codes that you had in one of your campaigns recently, and you mentioned that it's only now useful because in the UK we have track and trace app that was used to track the cases of COVID, and now people are actually using the QR code. So maybe a little bit on that, how the like technology changes or the social changes are driving the projections, or have you ever encountered anything like this?
That's a great question. Thank you. Yes, QR codes, we thought they will actually go into a graveyard, the tech graveyard, and here they come. Thanks to NHS app, everyone now knows that their camera is actually the scanner. So yeah, we reacted to it very quickly and implemented, also using a very old technology that actually generates those QR codes automatically and assigns URLs, so it closes the loop in outdoor. But all of that wouldn't have any application if people didn't actually know how to interact with the QR code. So now is the time, and it's one of those things when if you build a product and you are too early, actually that product becomes obsolete in few years' times, when all the libraries you use changed and all the integrations you've made are out of date, all the APIs you're using, that changes constantly. Software is never finished. It's a constant maintenance. So actually building it just in time is key here, and that's what saves you resources, expensive resources. And we also, so I hope that answers the question, and we also have a question from the audience.
Yeah. We have the questions from the audience, but I hope that like it will be way easier to just have them all at the end. Yeah,
Sure.
and Mick, can you tell a little bit about your experience, because you worked in brand, which is like a major success, and now you're in Traffit. So do you see those changes in, like, maybe more in Traffit because you are in a HR area, and so you might see those changes in society a little bit more?
Mm-hmm. Yeah, I mean, definitely from my side, I think, you know, when one of the questions we talked about as well a little bit, and maybe it'll come up later as well, is this, you know, when to re-project, when to, you know, change your projections based on what's happening in real time. You know, partly I would say, again, I will show my infancy here in this level, because my experience has always been that if you got an unexpected bump in your results, you were not changing your projections because it gave you a little bit of room to breathe. However, if you saw a drop, so for example, in Traffit, in the HR space, so I joined Traffit just 2 weeks after, 2 months after the first lockdowns. And, you know, the HR industry was not going no one was hiring, everyone was firing. And, you know, what I joined the company at the time, and the CEO, Adrian, said, like, you know, we're in touch with the board members, we're in touch with the initial investors, and we are just constantly talking to them daily. But what the team did in that what I would say maybe such a dramatic environment was the agreement with the board members was just to not predict anything for 3 months. Just switch to survival a little bit, you know, switch to survival, focus on the cost, don't focus too much on the revenues so much. And again, I'm not saying by any means that it's the right way, maybe it certainly might not be, but we probably went through a similar thing a little bit at Brand 24 when we had the encounters with Facebook that we had to adapt to as well, changing our agreement with Facebook and so on, and we had a 2 or 3 month period. So again, luckily for us, it was always about the investor board member relations and them agreeing, say, yeah, dig down, hunker down, hold it together, and you go from more like big 12 month predictions to weekly status updates and communication.
Yeah, as a person who is a huge fan of Michał Sadowski's photography and his stories as an entrepreneur, obviously that was a bit a bummer where I could not see his photos from traveling, but fortunately it's all back on Instagram and Facebook, so that's really great. And you mentioned that, like, reprojecting, so a little bit with that, so I want to ask about that clash a little bit of projection and actual results that you get. In the last 12 months, we saw the premiere of Cyberpunk 2077, yep, which generated record-breaking sales for CD Projekt Red. Yet when they released the financial statement for those few months after premiere, their stocks plummeted because they missed the analyst projections for about 100 million. Yet they still had the best year in their history. So can you tell a little bit about that, and maybe tell how it affects not only the company but maybe relationships with investors as well?
Yeah, I think, Dagmara, would you mind going first? Because I know in the pre-call you talked about this difference between projections and cost and not getting too much caught up. And I thought it was a great topic. I think I would love to hear your side, and I'll tag on the end if I can.
Thanks, Mick. Yes, so pandemic, we switched completely into survival mode. For me, it was all about stop investment and survive and see what our runway will be like. And we started, actually our metric became the months of the runway we've got left, because there was no way we could refinance, there was no way. at the start of the pandemic that at least this is what we thought, that we're not going to have access to finance, but actually the reality was completely different. So customers actually switched to buying stuff online, which we were offering, and the investment market was buoyant. So you could actually raise any kind of money you wanted during pandemic in UK, in the middle of pandemic. So that was really bad prediction on my part. We've ended up working crazy hours, and yeah, we had to hire. And I know a lot of companies actually had to build teams instead of scaling them down. So thankfully, we didn't do any silly cuts too early on, because we went into the preservation mode. But that was definitely wrong prediction on my part. I thought preservation would be the right thing, which is actually unlike me. I like a bit of risk, so normally I would be more optimistic than that. So that was one of the predictions. But to answer in a more general tone, when we're predicting, we assume that we're going to have funds coming in, and that to deliver certain prediction, we need resources. So we need certain amount of people, we need certain amount of support, and all important marketing spend, because that's what drives the growth. So your prediction actually will determine the costs you've got. So the plans you make on spending will determine that. But again, good modeling can help you safeguard against that. But that's the biggest pitfall to watch out. That buoyant projections means crazy costs as well, and sometimes it's very difficult to stop the spend before it's too late. But you always have option to go back to your investors and raise more money. So as long as you delivering the metrics, you'll be fine. So
yeah, I can only kind of agree with that one. I think, you know, the thing for, especially at Traffit, it's still it's a really nice, unique moment for me, because we are bootstrapping, let's say, or self-financing. So projections they need to be monthly kind of checked. There's no way to be kind of, and again, that's not with like a pot of profits. We are running toward, like you said, we have our runway, so that's really important. And I guess we're on this crossroads now at Traffit. I'm laughing. I talked to Adrian about this today, the CEO, that, you know, our projection is 2.4, you know, version 2.4. So we are making adaptations, and we are doing that. But the key for me is learning the difference between that over analyzing and not. That's something that's key. And thinking about that kind of North Star number in there, because now I'm a little bit hypersensitive to projections. So even if we are hitting our revenue and our MRR growth, I'm like, hey, listen, but look, our upsell carried us here a little bit more than we thought, and our new business was a little bit less. Let's react to that, because multiplied in 24 months, that actually will make a huge difference, even if it isn't a little bit month to month. But we might overanalyze. I genuinely don't know the answer there yet. That's the key of me. I don't know when exactly is the right moment. I would only say that we all probably fall into this frame of mind of doing it in December or in January because of those lovely calendar years. But it brought me back to the very first statement. You talked about like the different stages of projections, you know, pre-seed, angel, all the way to IPO. I guess if we were doing this right, we would probably, I could easily imagine having like even 8 or 9 of those stages through that life cycle. I still think it's crazy that we predict the growth of a company at $10,000 MRR and $100,000 MRR at the same time. You know, they are 2 completely different companies. But if things are going in the right direction, you tend to just go with it. But Yeah, I honestly don't know the answer. I talked a lot, but I don't know the answer. The only thing I can say is that it's better to double check than run down the road with the bad one, I would say.
Okay, and a little bit on that. Have you ever encountered any either of you that, like, because your predictions were not going as you planned, but you were still growing as a company, did that affect your fundraising process, or like the investors were not willing to give you as much money as you wanted because of that, or
Every single time. Every single time. Yeah, it's every time. Every time my projection is stripped bare and taken apart and show me the proof. Okay, great. So next month you should be here. Okay, so shall we put a meeting 6 weeks from now and check where you are? So that's how it goes.
So the one that I've always I say always come across in 2 or 3 scenarios. Investors have always tended in Poland to value the revenue are taking from outside of Poland. That was always the thing. Oh, look, we're on track. Okay, tell me how much came from expansion. Tell me how much came from the US. Tell me how much, you know, and you're like, yeah, but look, we hit the number. Okay, but you're still relying on Poland and yeah. So that was always a big indicator. And I do get it. I do get that $30,000 growth in outside of Poland versus Poland shows a bigger potential for the business, maybe long term. But it can be quite disheartening sometimes when you go and you say, look, we hit the numbers. And like Dagmara said, they go, yeah, but what about that one? What about that one? So yeah, that plays a big role. That was always the most popular one.
Yeah, that shows us as a nation that we are very hungry for international success.
Yes, but there is a flip side to this. We've actually had all our big ticket campaigns come from San Francisco, and they are US campaigns. And again, they say, okay, so let's remove those big tickets campaigns and see how you've grown in UK. So it works both ways.
Yeah, it's so ironic that next week I'm giving a presentation on why to narrow down your market and not to expand it. But yes, I think it's a safety metric for investors, like grow different countries, diversifying the portfolio, and it all makes sense. But as a young startup founder, that can confuse you so much that you suddenly start okay, we have to go spend money on London. No, that's really not true. And you know, you have to be able to stand your ground, and that's also quite daunting as a young startup founder, right? So yeah, it's really challenging sometimes.
I paid the price every time I did not stood my ground.
Yeah,
every time. Yeah. So it actually is worth it in the long run.
Yeah, and you slightly mentioned that, but because Dagmara, you are actually a founder, and Mick came to the existing companies, either Brand24 or Traffit. So can you give me slightly show us how you're approaching, like, maybe that projecting, or like for joining or creating the company in the first place, how you approach that? And maybe because Mick actually joined the company, I would like to hear from him. So how he was projecting those companies, and what was the reasons, those number reasons for joining a specific startup.
It's a very good question, and I hope I understood it correctly. So are you asking me how I raised my very first round?
So yeah, like how did you, both on that, but how did you like projected your idea as a company, and how that also changes over time? So
when I actually did my very first deck, it was very long and it had a lot of information. As we grew, our deck thinned down and has many far less words than it did. So actually, when you start out, you see this big opportunity. It's vast. You break it down into verticals, and there is a lot of it. What investors are actually looking at is what proof you've got that what you're proposing to the market actually is what the market needs, and the team. So those are the two elements you really need to focus on. And then how much money do you need to get to the next stage and what that stage will be? So 3 things. But I spent a lot of time, which took me away from the all-important talking to my customers and bringing the first sales and so on. That's what I should have focused on, but I focused on the deck and numbers. But in the end, it worked. The investor saw the potential, came on board actually, and helped me out a lot. So that was the start. And then as the company progressed, actually the most recent round was done on a one-pager. I didn't even produce a deck. It was a one-pager, and the investor, well, it was a small VC, said, we actually like the rigor of condensing this business into A4. It makes sense to us. We're going to do our research. And that was it. So actually less is more. The projection is the ballpark figure. So what is your North Star? Are you focused on that one key metric? And then of course you need a model to show how you're going to do it and how much money do you need and what will be your lowest point. So in your cash flow, actually in your lowest point should be what you're raising. So if you need 1 million, your lowest point should be about 800 with some contingency. Otherwise you don't need that much, or you're not raising enough. So that's also something to watch out for. But I guess that's obvious. So yeah, I don't know if that answers the question. You asked me how I've raised at the very start and how I made the projections.
No, I think it answers perfectly, because it shows also that like the founder approach, but obviously Mick was joining existing company, so probably the founders were showing those projections to him, and he was able to see that from the slightly different angle. Obviously, every founder has that mother-child relationship with their ideas, so they might over project certain things, while people who are coming from outside might see a lot of things differently.
So I'm probably gonna maybe it's the theme for today. I'm going to embarrass myself a lot right now with my little story for this topic. So when I joined Brand 24 from GetResponse, it was a really interesting time, because Brand 24, I think what we could say is like they were delivering on their projections, especially for the Polish market. I think they had at the time maybe 1 or 2 kind of angel type investors, and it was all going great. And I met with Michał, and I was very lucky that he decided to take me on board as that kind of kickstart to go international, which was great, made total sense. And he said to me at the time, like, Mick, can you make some projections? What do you think, what we're going to do together? Like, it's a blank slate. You've got a couple of team members, and I'd never done it before. I was working at GetResponse, which is a bootstrap company, phenomenally successful, and I'd never been involved in the finances and so on before. So I went to town. And the funny thing is, I would class myself as being quite okay in Excel and formulas. So I went crazy. And honestly, I really hope that Michał Sadowski kept this, because he should hold it over my head for the rest of my life, because I probably predicted that Brand 24 would be a unicorn in about 4 years. It was insane. Every number was going up, but it was a little bit like playing Monopoly for me, because I've obviously believed in myself, and I was like, yeah, there's no reason why this would not work. But at the time, Michał took it, and I think probably, he probably looked at this and said, well, Mick worked at GetResponse. Maybe he's right. And it was the opposite. I was just having fun. It was like playing a computer game for me a little bit. But ironically, after 3 months, the investors were on really good terms, and we looked at the projections and said, okay, now let's throw them away. Now do you understand? And I had like a trial by fire insight into startup world in a 3-month period where someone actually said to me, like, why that number? And I was like, it's a good question. Actually, I think so. I think Get Response were doing it around that conversion or that volume, and then you go, well, yeah, true. They are actually 15 years older, and they have more marketing campaigns. So I guess deep down in one of our Google Drives at Brand24, that projection stays, but we laugh about it because it was ridiculous. But that was because, and maybe this happens even today, that I try to avoid the fact that just predicting that even people coming in at a C-level or a mid-management position, they don't always know the startup world. I mean, I was going out there Googling MRR, ARR, CAC and run rates and so on, and speed catching up. But Michał, obviously, we just never had that topic in the interview kind of onboarding process. So he just kind of went with me, and yeah, so it was crazy, but it was the fastest way that I learned. But now I could look back at those numbers and say they were astronomically wrong, astronomically wrong. So yeah, that was crazy. But luckily, over 6 or 7 years and doing it a few dozen times, I'm hopefully better at it now a little bit. So.
Well, definitely. And for anyone who doesn't know the story of Brand24, Michał was talking about it over a few different podcasts. So it's definitely worth hearing because it's both hilarious and you can learn a lot from it. And his sheer dedication to this project was incredible. So it's fantastic to learn a little bit more about it. And I pretty much have only one question, but it will be probably the best for the very last. So now we can go a little bit to the questions from the audience, and they're both fantastic. I gotta admit, a little bit sad that I didn't write them before. But let's start from the first one. Did you ever have to focus on vanity metrics to secure new investments or to make existing ones happy? And maybe Dagmara, if you started with this one, that would be great.
Yes, I think it was vanity for everybody. So we got investment from a VC from Singapore, and as part of the deal, we got an office and a separate fund to set up operation in Singapore and Malaysia to service all of Southeast Asia. At the time, we were a tiny company still, and but we thought the investors know what they do, and they bolted us onto another advertising agency which they invested in, which employed 50 people. So we thought it's going to be all good. But what we've underestimated is first the time difference, the fact that I, as a founder, actually have to be there for the first 6 months at least to instill the culture, the product vision. Those things don't travel over Zoom, okay? So you have to be there. It takes adjustment into culture, wardrobe. So what I did not realize, it's actually that in Singapore, you need to be dressed for 16 degrees, even though it's 40 outside, because you spend most of the time in 16 degrees Celsius. You either in a taxi that is very cold, or you are in the office building that the more prestigious the company, the colder it is. So my wardrobe really stood a test. But that was just the start of all the cultural issues that I had to encounter doing business in Malaysia. It's a whole another topic, but I love the fact that I've got an office in Orchard Avenue and in Malaysia, and in Kuala Lumpur, and I love being in Asia and the weekends away in Bali and all of that. So that was a pure vanity, which took me away from my operation in London. But this is what the investor wanted, and actually it's what I went along with. So good learnings. Now I know what I need to do to prepare myself for going to Asia, but it was at the cost of the growth at the time in London. So that's not something that was beneficial for the company. So that was a vanity metric going global, and also expanding really quickly in terms of headcount, because he really wanted 100 people company overnight, and bolting us on with another agency which had 50 was the fast track to do that. So headcount is also one of those vanity metrics that investors love, and we as founders love it too. But yeah, it can come with a cost.
Yeah, and Mick, from your side.
Yeah, I mean, it's a really, really good question, because I think that the hard part is that sometimes the vanity metrics are also good ones, even though they are there maybe for the particular wrong reasons, let's say. I would say that a lot of it normally comes, again, we talked about this in the previous answers. I think that from time to time, maybe at Brand24 or even at Traffit, we sometimes look at those vanity metrics, but they weren't pushed by the investors. We just predicted. Investors want to see, lots of new clients, new growth, new MRR. So I've talked recently on LinkedIn about this. We talked about this, like at Traffit right now, we are very lucky because we've managed to really generate good negative churn. So we are now generating, say, 25% of our ARR growth this year will come from upsell. And probably 3 or 4 years ago, I would have told you that investors only care about new business. They're not gonna look at that. They just want new business. But maybe new business is important though, of course. So that's what I mean. Like vanity metric is a good way of explaining it, but sometimes they turn out to be true. I can flip this around a little bit and say that I've had the experience of, rather than the vanity metric, but the ugly metric, the unwanted metric. For me, sometimes was looking at things like margins and profitability. I have been with investors where they've said, like, spend as much as you can to grow. and wanting to sometimes say, like, how would you feel if we looked at, like, profitability instead? And, and I still do get it, because growth versus time is that lovely valuation metric. So it's not that it's wrong, but I did have moments in the past where I wanted to focus on also a little bit of profitability margins and not only grow at all costs. And that was something that I've come across. And I've heard many other founders talk about this kind of thing as well. So not limited to kind of a Brand24 thing, I would say.
Yeah, like what you said is, it reminds me of that ever lasting conflict between the founders and early investors. Like early investors know that at some point they have to get out, so
Yep.
they probably push a little bit too hard for like growing instead of reaching profitability. Yeah, so that's spot on.
It's not a case at all with my investors, but there is this legal aspect. So if you are an SCIS company and you got investment from an angel, if your company fails, they get 125% back of their investment. So that's the tax break. That's a tax break. So, understanding the motives of your investors, why they are investing, is just because otherwise they would have to pay everything. What they're investing in your business actually is what they would have paid in tax. So some high net worth individuals have that dilemma. So understanding the motives is really critical. So I was lucky enough to get investors that were passionate about outdoor market and disrupting that sector. I did it intuitively. Now, in the hindsight, I know this is more important. I was lucky that that's the decision I made, but there were other investors that I could have taken on board that perhaps didn't share the same vision, and but we're in it just for the money.
And yeah, I think that's like, I guess that's a really nice takeaway for anyone that's tuning in, is that, you know, it's a nice thing to say, but if you can be patient, and if you cannot, I've heard a number of founders who have said that they had really good experiences, not from taking the highest valuation, the highest offer, but taking the middle one. Because yeah, I mean, and it's really, you know, it's a shame. Sometimes it's a shame for everybody, because I do understand that money motivated VC who is like, hey, listen, I'm in here. My 3-year plan is to get out here. Nothing wrong with that. And then at some point in your journey, you can end up with conflicting things. Yeah, I want to get to profitability. I want you to get to a valuation. Like, you know, and that's a really exciting thing for me at Traffit now, because we are even like kind of pre-seed, let's say. We have some financial co-founders who have said to us, like, just keep building. Here's a loan, you know, here's this, just keep building, And I've never experienced this, like you said, coming in not as a founder. It's been a nice surprise, because I was able to come into Adrian, and my only advice to him as a first-time founder was, I'm going to really ask a lot of questions to these VCs. Like, I'm going to ask them, like, if they want us to grow abroad, how do they help? You know, what is their experience in doing this? What is their exit policy? All those things that, you know, but I still, you know, I think I also know that is idealistic. A lot of startups need investment to keep the lights on. And that's, you know, so I am talking about the perfect ideal approach, let's say.
Yeah, like, and you're obviously touching a little bit on the second questions, and like what you're saying, it always like brings that little voice in the back of your head that, like, it's more important to get the good investors rather than getting them in the first place, because like in the long time frame that will probably bite you. So on what you said, Mick, so how did you productively disagree with investors?
Yeah, it's a great question. And I guess, you know, based on the status of the company at the time, sometimes it wasn't productive. Sometimes it was difficult. Sometimes you had to close the door and sit down for 4, 5, 6 hours. And, you know, there was many times that I said to my wife, like, okay, I've got an investor meeting today. I have no idea when it will finish. So you had to be ready for that. But, you know, again, I'm gonna take the easy card here. Not being the founder or the CEO did put me in a different position. So I probably felt I felt very empowered to explain, to talk. Our investors at Brand24 were always open to conversations. I don't remember ever getting to a scenario where there was an ultimatum. But I also remember having this revelation, and Dagmara, I'd love to even expand on this a little bit, to say, if you've probably never had to think about this, but I guess, you know, I also never really had this consideration that CEOs get fired. And I remember one of our competitors at Brand24, one of the CEOs leaving the company, and me going like, I didn't really know that happened. And then, you know, you start to research, and again, me on my fast track of learning startup world, that, you know, the power balance also, you know, there is no way that a CEO can just say it's my way or no, because the board and the investors, they do have relatively lots of power as well. So I used to see those meetings and understand the emotional and challenging side for someone like Michał Sadowski and Piotr, who was his co-founder, trying to balance that. Hey, listen, we need to do it our way, with, I still want to be a team with you. We still have to leave this page on the same page. I don't know, Dagmara, if I guess, you know, when the results are good, you never have to have that realization. But when you have hard times, I almost, like, you know, it was an eye opener for me to think that CEOs get replaced from time to time.
Yes, so this actually touches on a few aspects. So first one is, every investment leads to dilution. Mm-hmm. So I actually had that conversation with my husband recently, where we had an offer for investment, and we just thought, actually, at that level, we would buy the shares ourselves.
Sure.
So, that actually also settles your BATNA. So, well, how low can you negotiate? But so as long as you are a majority shareholder and a CEO, you really call all the shots.
Sure.
Then you get diluted. Then your co-founders, you can actually protect yourself in those early stages where all the co-founders actually have special share class, and that protects. But that there needs to be a consensus between the co-founders that they actually chose that CEO, and they're gonna protect because we protecting our interest as founders. And something that I've learned is that for that to be enforceable, you actually cannot be represented by separate lawyers. So you as one say that what's good for us is good for a company and vice versa. So you can protect yourself that way. Then, of course, as you dilute yourself and go with a simple majority, meaning 50%, or the statutory majority, 75%, depending on your shareholder agreement, you do need to make peace and provision for changing CEO. So I actually don't have a problem with hiring a professional CEO at some point.
Yeah.
I actually am at the stage where I really enjoy leading the business, but once you get to the multinational structure where there is a corporate governance involved, where you need a chairman, where you need a proper professional board, why not give it to professionals? Just an idea, but I mean, maybe it will never happen. Maybe we'll never have to do it. Maybe I'll just learn everything I need to learn along the way. But again, it's a failure. It's on a personal level, but I think getting used to that failure early on will help you stay sane. So yeah. I'm aware of that, but it all comes to dilution. So every investment round gets you closer to that moment.
Yeah, I mean, I've luckily never left a board meeting or a shareholder meeting at that stage where, you're at ultimatum level, which is great. I'm super happy about that. But certainly I did feel this little bit of a disconnect that for me, certainly in the early stages of Brand 24, it was a job. I wasn't the co-founder. As I progressed into Brand 24 and now at Traffit, I definitely feel completely differently about my shareholders and the board members, that there's a much more motivation to find the solution, to find that side as well. So yeah, it's a really good question though. I mean, it's a really good question. I think that we probably predict the worst sometimes with investor relations, that they are these hard people pushing us all the time, squeezing our buttons. But one thing I've said to Adrian here at Traffit, while we decided not to raise for the next 18 months, let's say, while we go through the decision, I said, maybe we will create an advisory board. And he said, why? And I said, because at Brand 24, having shareholders and going to those tough meetings and answers, it made us better. Yeah, no question. Absolutely. No question. I think being left alone with no oversight is probably one of the scariest things ever for me, because I love my job. I love what I do, but I get very excited about it. And sometimes you don't see the forest for the trees, as they say. So I miss them. I miss them at this stage. We have some great board members that help, but I asked them to seriously consider executive board or, advisory board, because they so many times in Brand 24, they steered us back on track.
Absolutely, yes. Advisory board was crucial to us at those early stages. Maybe they were too agreeable. Although I had some members that were tough cookies, and actually they became my mentors. Those that I disagreed most with became my mentors, and for a while I made time to do a morning coffee or breakfast, because there is no excuse not to have time for breakfast with your mentor. And just sharing ideas with him, and the sheer silence after I spoke said everything.
I will have to jump here because we'll be going to the end of the webinar. But we have also one more question from the audience. Do you think that Poland is a good place to found a startup? Does the government or legal system provide sense of security for young businesses? And it's really great question for you, Mick, because you're not from Poland. So you actually probably are way more objective on this than me or Dagmara.
I mean, you know, in some respects, yes, but also, like I said, remember that I've never done it outside of Poland, so I'm still a little bit. I'm biased. I mean, what I can say is I haven't experienced any particularly negatives. That's what I can say. I haven't seen a startup that fell down or fell apart because of governmental scenarios. Maybe there's not as much money floating around, but I also think that, you know, I've seen I guess in Poland, it was very lucky that they were part of the EU for a certain period of time. A lot of startups around there. Brand24 had EU funding. I think, you know, a number of the other ones around then. So that was, I think that when I was joining the startup scene in Poland, it was a very affluent time of funding and those kind of things. I haven't seen anything bad. That's what I can say. I think the key scenario that maybe the only thing that I would like to see more in the Polish market is actually two things. And it's nothing to do with the government, ironically. So I'm gonna grab this time. I think that we can be more optimistic as a professional band, aim a little bit higher, because I know a lot of great founders that probably started out wanting to just earn a good salary for themselves. There wasn't the slightly bigger picture, let's say. And I think the second thing is just to be less afraid of failing, or failing doesn't hurt as much as you think. And that's something that I think that I always remember meeting British founders or US founders when I've been lucky to travel. And the story of it's my fourth startup, it's my fifth startup. I blew, you know, $7 million in this money. I did it. And in America, the next investor was seeing this as such a positive. At least, you know, they were like, great, so you've learned from all that. Yeah, done. In Poland, I meet some people sometimes and they're like, yeah, my idea didn't work, so I went and found a job on, you know, on Praca UPL, and I jumped straight back into being an employee. And I was like, don't be so afraid. So I think that's a big difference that Poland could even expand on.
Okay.
Yes, well, I think Poland is the hub for talent at the moment. So when we went to pitch, do our first pitch, I said to my investor and co-founders, shall we get someone from Cambridge to pitch and be very posh? And they said, no, it's not going to sound as authentic. I mean, he said, I think all the best IT and the best tech at the moment is coming out of Poland, doesn't it? So I think you're going to sound more authentic. So you go and do the pitch. So I mean, we're starting to have a brand as Poles worldwide. So that's one thing. So be proud of how you sound. That's what I'm saying. Do not worry about that, because I know a lot of founders may feel like it's better to get an English guy present to the English audience. There is some merit in that, but what's also important is being authentic and be different. So if we've got this Polish heritage, let's show it. What else? I think women are treated equally in Poland, which is not the case everywhere. I've never experienced any sort of mansplaining or talking down in Poland. So that's something I think that Poland worked really hard towards in Polish workplaces, and it's really paying dividends. So that's fantastic for all the female and non-female founders. And yeah, I think the talent and the diversity is great.
The work ethic is ridiculously better in my opinion. And to me, I think the commitment to the role, the commitment to growing companies from top to bottom. And yeah, I still remember I got ridiculously mad at a TechCrunch reporter who came to Poland a few years ago and said, Poland doesn't have a unicorn, so obviously it's not working. Total rubbish. It's got nothing to, that's not the metric that we use in this world to know what's good or bad. So yeah, like I think actually Poland did quite well when a lot of people were not picking them up as well. So no, I agree with everything Dagmara said.
I would say that like the name of unicorn got diluted recently a lot because a lot of companies that do not have proven business model are valuated over $1 billion, and the companies like App Annie is valuated only about 500 million, which is working and like absolutely great service and platform that is used for most companies in mobile apps area. So it's sometimes ridiculously funny to hear about valuation of certain companies. Unfortunately, we're going to the very end, and even worse, we didn't hear any failure stories. So we are changing the rules a little bit. I understand no one wants to talk about their failures, so the free ticket should go to the person who asked the best question. And if you can choose your favorite question, that would be great. If you can choose whether that was about vanity metrics or disagreeing or arguing with your investors, or the question about Poland as a good place to found a startup. And yeah.
So I think I'm going to give my vote to the vanity metrics question, only because I think it helped us maybe lift the lid on it a little bit. And I know that it's a scary thing. I think it's a scary thing of, should we do what's best for the company or do what makes the company look the best? So I appreciate that the person asked that, because it's also a difficult question to answer. So it probably just nips it for me. So I'll go with vanity metrics.
Yeah, I think it's a good choice, but it's a tough one. Very
it is a tough one.
I believe those memories from weekends in Bali for you, Dagmara, were definitely helping with that choice. So I'm very happy to announce that the person who asked that question, and that is Alex Singleton, and he is from America, wrote that question. So
awesome.
Like awesome, Alex, you definitely deserve that. And I would like to thank you both, Mick and Dagmara. It was absolute pleasure to have you here. Like I learned so much, and I have so many follow-up questions that there is a chance we'll be asking you to have a round 2 of that talk. So I hope that you will answer our calls, and thank you very much for joining us today.
Always a pleasure, and thank you, Mick. You've been fantastic co-webinar buddy.
Well, no, thank you as well. And I'm gonna, the great thing for me is that sometimes these things the people who are employed after founding don't always get a say here. So I hope it was a unique experience. But I learned a lot. Dagmara, a couple of things, even from our warm-up session last week. I ran away and I talked to our CEO about it. So it was a pleasure. And the thing to say is, just as a disclaimer, we haven't mastered the art of projecting results yet. That's for sure.
Nor have we. And I think if I may, I will follow up on some growth questions, because I think I need a couple of pointers from the pro. So thank you very much, Mick.
Perfect. Thank you too. Thanks for inviting us.
Thank you.
Thank you,
Thank you
Adrian.
very much.
Thanks. Thank you.